Warren Buffett earns over $6 billion in dividend income every single year, not from selling his stocks, not from trading, simply from owning them. In the next 9 minutes, you are going to learn exactly how dividend investing works, why it is one of the most powerful wealth-building tools ever discovered, and how you can start building your own dividend machine today. Let us start at the beginning. A dividend is a payment a company makes to its shareholders, a portion of its profits, distributed directly to the people who own the stock. Think of it this way. When you buy shares in a company, you become a part owner of that business. And when that business earns a profit, it can do a few things with that money. It can reinvest it back into the company to fuel growth. It can buy back its own stock, or it can share those profits directly with its owners, with you, in the form of a dividend. Most dividends are paid quarterly, meaning 4 times a year. Some are paid monthly, a few are paid annually. The dividend is usually expressed as a yield, a percentage of the stock's current price. So if a stock trades at $100 and pays $4 per year in dividends, it has a 4% dividend yield. Now here's where most people stop thinking about it. They see 4% and think, that is decent, but not spectacular. But that thinking misses the entire point, because dividends are not just income, they are the engine of compounding. And compounding, as Albert Einstein reportedly said, is the 8th wonder of the world. Here is where the real magic happens, and the math is going to change how you think about money forever. Imagine you invest $10,000 into a stock with a 4% dividend yield. In year 1, you collect $400 in dividends. Nothing earth-shattering, right? But here's what most investors do wrong. They take that $400 and spend it. They never let it work for them. The smart move, the wealthy move, is to reinvest those dividends. You take that $400 and buy more shares of the same stock. Now in year 2, you are not just earning dividends on your original $10,000. You are earning dividends on $10,400. Your dividends generate more dividends. Over 10 years, your original investment grows to nearly $15,000 without adding a single penny of new money. Over 30 years, it compounds to over $32,000. And that assumes a flat stock price and a constant dividend. In reality, the best dividend stocks also grow their dividends every year. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have raised their dividends for over 50 consecutive years. These companies, known as dividend aristocrats, do not just pay you, they pay you more every single year, like clockwork, regardless of what the stock market is doing. This is why Warren Buffett's annual dividend income from just one stock, Coca-Cola, now exceeds what Berkshire originally paid for the entire position. He is now earning more in annual dividends than his original purchase price, every single year. Now that you understand what dividends are and why compounding makes them so powerful, let us talk about how to actually pick great dividend stocks. Because not all dividends are equal. In fact, some of the highest yielding stocks are traps that will cost you everything. Here are the 4 criteria that separate great dividend stocks from dangerous ones. First, the payout ratio. This tells you what percentage of a company's earnings are being paid out as dividends. A healthy payout ratio is generally between 30 and 60%. If a company is paying out 90 or 100% of its earnings as dividends, that is a red flag. It means there is no room for error. If earnings drop even slightly, the dividend gets cut, and a dividend cut usually sends the stock price crashing. Second, dividend growth history. Look for companies that have raised their dividend consistently for at least 5 years. 10 or more years is even better. This track record tells you that management is committed to rewarding shareholders and that the business is healthy enough to grow those payments. Third, free cash flow. Dividends are paid from cash, not from accounting profits. A company can show strong earnings on paper while actually burning through cash. Always check that a company's free cash flow is comfortably above its total dividend payments. Fourth, business durability. The best dividend stocks are boring, essential businesses, utilities, consumer staples, healthcare companies, businesses that people need regardless of whether the economy is booming or crashing. These are the dividend machines that keep paying through recessions, pandemics, and market crashes. During the 2008 financial crisis, while the stock market lost 50% of its value, many dividend aristocrats kept raising their payouts. That is the power of owning essential businesses. This brings us to one of the most exclusive clubs in the investment world, the dividend aristocrats. To be a dividend aristocrat, a company must be a member of the S&P 500 index and must have raised its dividend every single year for at least 25 consecutive years. There are currently 66 companies on this list. Think about that. These companies have raised their dividends through the dot-com crash, through the 2008 financial crisis, through the COVID pandemic, through every recession and correction of the past quarter century. Companies like Johnson & Johnson, which has raised its dividend for 61 straight years, Coca-Cola with 62 consecutive years of dividend growth, Procter & Gamble with 67 years. These are not lucky streaks. These are businesses with structural competitive advantages that generate consistent, growing cash flows. Owning a portfolio of these companies is not glamorous. You will never have a story that goes viral in a stock trading forum. But over 10, 20, 30 years, this strategy quietly and consistently builds wealth. Studies have shown that dividend aristocrats have outperformed the broader S&P 500 index over the long term, with less volatility. They go down less in bad markets and participate in good markets. That is the combination every investor is looking for. So how do you actually build a dividend portfolio? Start with these principles. Diversify across sectors. Do not put all your dividend income eggs in one basket. Spread your holdings across utilities, consumer staples, healthcare, financials, and industrials. Aim for at least 15 to 20 different companies. Target a blended yield of between 3 and 5%, high enough to generate meaningful income, low enough to avoid dangerous yield traps. Always reinvest your dividends in the early years. Let compounding do its work. Set up automatic dividend reinvestment through your brokerage. Most offer this for free. And be patient. The biggest mistake new dividend investors make is selling during a market downturn. Remember, when stock prices fall, dividend yields rise. A market correction is not a disaster for dividend investors. It is a sale. You are buying more dividend income at a discount. The wealthy know this. The wealthy stay the course. And the wealthy watch their dividend income grow year after year after year. Dividend investing is not a get-rich-quick scheme. It is a get-rich-for-sure scheme. If you are patient, the dividends will roll in, the reinvestment will compound, and one day, you will look up and realize that your money is working harder than you ever did. If you found this valuable, subscribe to Market Mapped for more in-depth investing lessons every week. The link is right below. See you in the next one.